We've all seen The Wolf of Wall Street. This, however, is the story of the real Jordan Belfort, the character to whom the film was inspired, the real Wolf of Wall Street. Hi, this is Veni Vidi Vici, and today we're talking about Jordan Belfort, the real Wolf of Wall Street. Jordan Ross Belfort was born in 1962 in New York and grows and studies in Queens. For a lot of information about his story, we have to trust what he will tell us. In the famous 2007 autobiography, from which the film was then taken. So if some information doesn't come back, unfortunately, it's linked to this testimony. Belfort is a difficult teenager. He suffers from anxiety, comes from a not-so-rich family, and his classmates make him feel bad. He should be appreciated, and in his insecurity, he thinks there's only one way to do it: money. You can see it from the first choices he makes as a kid. For example, in the summer of 1979, at 17, Belfort starts buying ice cream tins at the corner with a friend. Then, he sells them on the street at a slightly higher price. Thanks to this expedient, they earn their first $20,000. Of course, he always told it. After studying biology at the University of Washington, Belfort starts working for a company that sells meat and frozen fish. After putting money aside, he founds his own food-selling company. Businesses are going well for him, but all of a sudden, according to his story, sales plummet. And so Belfort is forced to declare bankruptcy. Let's start very well. At 25, he has to find a way to restart his career, to reinvent himself. Besides, he can count on the gift of being a born salesman. He knows how to deal with people. He knows how to make a product appealing, and how to convince potential buyers. We saw this in the movie too. After a while, in 1987, a stroke of luck comes. A friend of his family gives him a blowjob. The investment bank, L.F. Rothschild, a Wall Street-based company, is hiring salesmen. It's a starting position, but in a fairly important company. Belfort manages to get a job, and even finds a job as a salesman. He can get the job because, to become a salesman in the States, he has to pass a test called Series 7. To pass it, or participate, you don't need a specific degree, neither at the time nor now. Series 7 only attests to the knowledge of the world and the rules of finance. If you pass it, you get a license, and you can work as a stockbroker. Belfort can then prepare for the exam. While performing the test, and if it goes well, he will be hired as a broker in all respects. It's done, you might say. But in reality, this is just the beginning of his story. In the 80s and 90s, Wall Street is a place dominated by ambition and greed. There is only one rule: make money and spend money. It doesn't matter how. But at the beginning, the career of the future Wall Street wolf is quite calm. In his position at Rothschild, Belfort calls potential buyers and then passes the phone to a broker to finish the sale. If the business goes well, he earns a small commission. And after a few months, Belfort is able to get a job. Belfort also surpasses Series 7. Happiness. But it doesn't last long, because immediately after despair, the moon is black. On October 19, 1987, Wall Street collapses. L.F. Rothschild goes bankrupt. One of the worst collapses in the history of the U.S. stock market. Billions of dollars were lost all over the world. Belfort thought he was at the beginning of a stellar career, but instead, he is left without a job. So, as sometimes happens, he has to reinvent himself again. He looks for another job in the world of finance. In a short time, he finds a job at the Investor Center, a small brokerage company in the outskirts of Manhattan. Much worse than the previous job, but better than nothing in the end. Unlike Rothschild, the Investor Center works in over-the-counter markets. These are unregulated markets. What does it mean, unregulated or regulated market? A regulated market is, for example, the New York Stock Exchange, the NYSE. Its role as a stock exchange is to facilitate exchanges centralize the communication of prices and financial securities. Prices that at a given moment are the same for everyone, although changing from moment to moment, as we know. And whoever wants to buy and sell does not need to hire someone, just send the order. In addition, a stock exchange like the NYSE, a regulated market, imposes rules to ensure the transparency and solidity of listed companies. For example, it obliges, if they want to be traded in the stock exchange, to publish the balance sheets in the most complete way possible, in addition to contrasting incorrect practices. Over-the-counter markets, on the other hand, must only respect the law imposed by the states. Data on companies operating in the over-the-counter market can also be very difficult to find because companies are not obliged to publish data, as much as in regulated markets. And even just talking about listed companies is totally out of place. To invest in the over-the-counter market, you have to agree with a counterpart. You can go through a brokerage company, but it is not necessary. So much so that intermediaries here should not even have a license as a broker, at least in time. In unregulated markets, in addition, the value of the securities is never defined. It is not public. Even in a given moment, there is never a single price for everyone. Most of the negotiations, in fact, are between private companies. The price is always decided in each negotiation. Intermediaries, brokers, are not necessarily needed here, especially because they are great investors to talk to each other. However, brokers can help you choose which companies to invest in and to deal with the price. The problem is that given the undefined values of an OTC market, it can be more easily subject to scams, especially in the days of Belfort before the most recent regulations. In fact, the operation of the Investor Center, where Belfort works at the end of 1987, is not very honest. Small companies like the Investor Center, which sell options on the over-the-counter market to small investors, are also called boiler room locale caldea, small and narrow places where dozens of brokers work on the phone to contact many potential small investors to convince them to invest. And usually, they target inexperienced people. At the Investor Center, Belfort and other brokers deal with penny stocks, that is, non-quotable small company shares. Shares that usually cost less than $1 a share, to guarantee the possibility of buying them easily. These penny stocks are sold in packages. After all, one does not invest 10 cents. The people they contact are made to believe that they are safe investments, even if they are high-risk operations. After all, they are small companies. Belfort, who, like his colleagues, earns commissions on each operation, is interested in bringing to an end as many transactions as possible. And he's really good at this. Over the course of 2 years, he manages to earn tens of thousands of dollars a month, so much so that he can afford to buy luxury cars. But Belfort wants to aim even higher, and therefore decides to invest. In 1989, he quits the Investor Center with the idea of moving on to the next level, founding his own brokerage company and making it the largest over-the-counter company in America. If you've seen The Wolf of Wall Street, you'll definitely remember the scene where DiCaprio and Jonah Hill get into business. In reality, Jonah Hill's character in the film Donnie Azoff is called Danny Porish. It's his neighbor who's having financial problems. In 1989, Belfort convinces him to take the exam, to become a broker, and get into business together. Once he finds a partner, he contacts a brokerage company, the Stratton Securities of Queens, and agrees to open a subsidiary that he himself would have managed. With the money set aside, Belfort and Porish soon take over the entire Stratton Securities. In 1989, they become owners and change the name of the company to Stratton Oakmont. After that, they surround themselves with trusted collaborators. First of all, they contact a number of their childhood friends and convince them to work for them. Then, they hire dozens of guys who they promise will earn several $1,000s a month. Belfort provides them with a real manual to learn their strategies to sell shares and earn in commissions, a bit like what happened at the Investor Center. Brokers earn both when customers go positive and when they lose money. Their interest is simply to get as many operations as possible done. Compared to before, the operating scheme of Stratton Oakmont is a bit more pushy. So brokers also contact high-income people who could move tens of thousands of dollars. The techniques developed by Belfort with penny stocks also work with them. Now, the aggressiveness in selling itself is not a crime. The problem is that they also use a fairly famous system. In the world of financial frauds, the pump and dump, pump and unload, which is illegal. It's a market manipulation. We'll explain in a moment how the pump and dump works. It consists of inflating the price of an asset for a limited period. How does it work? You buy that asset in large quantities, or by spreading false, altered information. That boosts the price. The news spreads to push people to buy that asset, making it increase in value. Then, the scammers typically sell everything before the price goes up. This is what Belfort does. At first, it contacts some trusted people, to whom it says to buy a large amount of shares of small companies. Belfort calls these collaborators rat holes, tanedi topo. The name is definitely not very flattering. When the rats manage to hold a fairly large percentage of shares, Belfort orders his employees to immediately look for potential buyers. The broker's army then calls potential investors and presents these shares as excellent investments. They leverage the operations of the rats. More and more people then buy those shares, and their price continues to rise in a vicious circle that will attract more and more investors. But in reality, the shares are pumped by the rat hole. There is no real reason why they grow in value, except for the artificial increase in demand. When the price of the shares reaches a certain level, Belfort calls the rats and tells them to sell their shares. It allows them to sell them at the peak of value before the inevitable collapse. When the shares are downloaded, the brokers stop promoting them, and the price drops sharply. The demand for those shares suddenly disappears, and those who still own them can no longer find anyone willing to buy, except at extremely low prices. It doesn't matter if many investors lose their money. Stratton Oakmont has already made huge profits through commissions. This pump and dump scheme works so well that within just a few years, Belfort ends up employing almost 1,000 people. At this point, the wolf decides to aim higher. He wants to return to Wall Street, to regulated markets. Normally, when a company wants to go public, it turns to an investment bank, but it can also use a brokerage firm as an intermediary. By now, Stratton Oakmont is well known, and companies begin to contact it directly to help them list their shares, acting as a sort of guarantor. Belfort manages to bring dozens of companies to the stock market using a system very similar to the one he had already used in the OTC market. Before the IPO, the initial public offering, Belfort asks his rat holes to buy large quantities of shares so that their price will rise immediately after the listing. This time, however, prices are public, and even experienced investors who normally operate on the New York Stock Exchange can be drawn in. As a result, the risk of being discovered becomes much higher. The pump and dump scheme always ends in the same way: a massive sell-off. Belfort, his rat holes, and his brokers all profit from it, both by selling before the crash and through commissions. Among these operations, the most famous one is the 1993 stock market listing of Steve Madden Limited, the shoe brand. According to several accounts, it was Steve Madden himself who asked Belfort to carry out the pump and dump, starting to place shares before the company was publicly listed in order to push the price to around $4 per share. From this single operation, Stratton Oakmont reportedly earned about $20 million, while Madden was able to raise far more capital through the public listing. Thanks to these tactics, in the early 1990s, Stratton Oakmont became one of the leading brokerage firms in the United States, with more than 1,500 employees. According to Forbes, each of them earned at least $85,000 a year. Belfort is now extremely wealthy and indulges in the wild lifestyle portrayed in The Wolf of Wall Street. But it is precisely his irregular practices and extraordinary earnings that attract unwanted attention. In regulated markets, oversight is much stricter, and after years of success, Belfort has pushed things too far. Many companies brought to the market through Stratton Oakmont show the same pattern: a sharp rise followed by an immediate collapse. When this happens repeatedly, suspicion is inevitable. This is where the fall of the Wolf of Wall Street begins. As early as 1991, Forbes raises doubts about the mysterious Jordan Belfort with an article titled, "Stakes or Stocks? What's the difference?" The message is clear: just do the math. The article reports complaints from clients who had lost a large portion of the money they invested. It happens too often to be explained by honest mistakes. Either Stratton Oakmont is incompetent, or it is running a scam. The company therefore draws the attention of the SEC, the Securities and Exchange Commission, the authority responsible for supervising financial markets. In 1992, the SEC accuses Stratton Oakmont of market manipulation and defrauding its clients. In particular, investigators focus on a single case. Between 1989 and 1990, Belfort's firm had almost tripled the price of Nova Capital shares without any significant announcements or industry news. According to the SEC, this was a deliberate pump and dump scheme that generated around $11 million. The case continues until 1994. Stratton Oakmont settles, paying a fine of $2.5 million. In exchange, Belfort agrees to give up the company's assets, and his broker's license is suspended. But this is still not enough to stop him. He continues doing business through his partner, Danny Porish. At the same time, Belfort also comes under the scrutiny of FINRA, which oversees OTC market activity, and even the FBI. Gregory Coleman, who also appears in the movie, draws the attention of federal agents. Before the investigations fully unfold, Belfort asks several associates to physically transport large sums of cash to Switzerland, using the name of his wife's aunt as a front. The money comes from Danny Porish, who is still running Stratton Oakmont. Despite these efforts, Belfort's empire begins to crumble. In 1996, his yacht sinks off the coast of Civitavecchia in Italy. Under mounting pressure, Belfort's abuse of alcohol and drugs intensifies, to the point where he nearly dies in a car accident. Meanwhile, more and more clients realize they have been scammed and begin filing complaints. In December 1996, the irregularities committed by Stratton Oakmont are officially confirmed, and the firm is shut down. At this point, several federal agencies are investigating Belfort. In Switzerland, a banker, risking serious legal consequences, reveals that he helped cover up the illegal operations of Jordan Belfort and Danny Porish. Finally, on September 2, 1998, both men are arrested. They are charged with conspiracy to commit money laundering and securities fraud. Once again, however, the Wolf of Wall Street knows how to land on his feet. He returns to sales, but this time, he doesn't sell stocks. He sells out his former associates. Belfort immediately chooses to cooperate with authorities in order to reduce his sentence. Initially, he faces up to 20 years in prison, but he becomes an FBI informant, helping to put dozens of accountants and finance professionals behind bars. And how much is that cooperation worth? In the end, at the 2003 trial, Belfort is sentenced to just 4 years in prison instead of 20. Of those 4 years, he serves only 22 months thanks to good behavior. It is in prison that he writes his autobiography, The Wolf of Wall Street, a title he invents himself. After his release in 2006, Belfort is ordered to repay his victims $110 million, roughly half of the money he is believed to have made through fraud. But his story does not end in financial ruin. Even decades later, Belfort remains active. Today, Jordan Belfort is a free man. He claims to have left financial fraud behind, but his reputation as a salesman remains intact. His books are published in more than 40 countries and translated into 18 languages. Above all, it is the movie that makes him known worldwide. In 2011, he sells the rights to his first book for over $1 million, even though by 2018, he still owes $97 million in restitution to his victims. Based on the story that made him famous, Belfort now earns a living in what appears to be a legitimate way. He gives motivational speeches and sales seminars around the world. In 2014, each speech earned him around $30,000. Today, he can charge up to $200,000 for a live event. He even runs a YouTube channel called The Wolf of Wall Street. He appears to be a new man. But the question remains, will he ever truly repay the money owed to his victims? I'll leave that for you to decide.